Hi, my name is Stuart and welcome to the Investopoly podcast. My goal is to share easy to understand evidence-based holistic insights to help you master the game of building wealth. And if you're a regular listener, you would know by now in my Wednesday episodes, I talk about the theories, methodologies and principles associated with investing. In these case study episodes, my goal is to share with you how it all works out in real life and then look at actual case studies and ask ourselves, what can we learn from this, both from a positive and negative standpoint? And I feel like we've got a really good one today. There's, I guess, a good and bad news from it. The bad news is sort of circumstantial, nothing we can do about that, but the financial planning news is kind of good. So I started working with these clients in 2015, so about 9 years ago, almost a decade ago, and their starting position, they had a net worth of $1.35 million. And that consisted of about $500,000 in super, and the rest of their net worth was equity in investment properties. They owned 4 investment properties, and across those properties, we estimated, at least at that time, $835,000 of equity in those properties. Our first starting point when working with new clients is to work out, okay, what is the longer term plan and what contribution, if any, will existing investments make towards that plan and obviously towards achieving their financial goals. It's not uncommon that we meet clients with a property portfolio, if it's more than, well, actually any sort of size portfolio really, particularly if we met a client with 4 properties, chances are they're not all great, right? Either because they've made mistakes from the outset, the fundamentals weren't correct from the outset, or it hasn't turned out how we had hoped. And look, we've got to be careful in that circumstance. We can't just turn around and go, oh, well, we bought this 10 years ago, returns have been poor, let's get rid of it. The last thing you want to do is read in the newspaper in 10 years' time it's resold for 2 or 3 times of what you sold it. You only kick yourself as a result of that. So we've got to determine whether is it just market-wide? Has the market been poor and we should continue to have the patience as a long-term investor and wait for it to turn around? Or is there something fundamentally wrong with this asset and therefore the returns are going to be poor in the future? Or is it sort of line ball? And if it's line ball, that's a difficult one, but we would typically be conservative and then accommodate that in the strategy, which I think this case study highlights quite a bit. So these clients were renting at the time. They held 4 investment properties, but they were renting at the time. Their income wasn't as high as it is today. So from a cash flow perspective, we had a sort of lower borrowing capacity to play with. The 4 investment properties, one was in Perth, a couple in New South Wales and Sydney, and one in South Australia in Adelaide. We looked at these properties. We thought one of the properties, quite a low value property, at least at that time, 10 years ago, it was worth $280,000. We thought that was a pretty poor asset. One located in a pretty good suburb of Sydney, we thought that's probably their best asset. The one in Perth, obviously Perth, has been in the doldrums for a long time. Well, really the last 15 years, excluding the last 12 months. So the preceding 15 years. So we thought, well, why would we sell that property in a terrible market? We're going to have to sort of give it away a little bit. And the one in Adelaide certainly didn't have that strong historic performance. So we sold the one in New South Wales and the one in South Australia, and we retained the good quality asset, probably their best asset, inner city Sydney, and then kept the Perth property as well. And the plan was then to replace those 2 assets with a couple of investment properties, a couple of investment grade investment properties. And so we purchased a apartment for about $600,000 in 2016 in South Yarra in Melbourne, in a really great pocket in that suburb, a 2-bedroom apartment. Now, only a year later, their income changed quite considerably, which obviously changed their cash flow position and their borrowing capacity. And so we asked ourselves, well, should we buy that second investment property, that's the second additional investment property, or should we change the strategy, particularly given that cash flow had changed? And so looking at it, I thought, okay, we've got these 3 investment properties, which was Perth, Sydney, and now Melbourne, the new one in Melbourne. We liked Sydney and we liked Melbourne. We were sort of big question mark on Perth because, the whole market was in doldrums. And so when I have a situation where I've got some existing assets, but there's a risk that they won't make as large a contribution to their financial future as we would hope, one way to mitigate that risk is to level up on quality. In that situation, what that meant is, well, instead, why don't we just buy a really awesome asset, one that we've got much higher confidence that it's going to deliver strong capital growth. And that way, even if the investment properties don't work out in terms of growth, I'm sure they will in the long run, the very long run, but even in the interim, if they don't work out, at least we've got, this wealth in our home. And I say home because as I said, they were renting at the time, but, I've spoken about in this podcast many times that, your home can arguably be one of your best investments if you buy it with an investment lens. So that is, buy a great investment property, but then occupy it. There's some great benefits there. Of course, the the debt isn't tax deductible, so the interest cost is higher. But if we can put some cash flow towards it, that's not too bad. And the kicker is that we don't pay capital gains tax, and that's why it can be one of our best investments. And so we purchased in 2017 a great property for just under $1.7 million, and that was their home. And I should say, I've mentioned this previously as well, is that, it has some positive lifestyle consequences as well. They own their own home, they feel comfortable, secure, safe. They can make some renovations or improvements to that home. It does have positive lifestyle consequences. Unfortunately, these clients separated just recently over the last year or so, and they had to sell that property. So, as I said, they bought it in 17. We're selling in 2024. So only 6.5 years they've held the property for. They sold it for $2.7 million, which was kind of bang on and I'm not mentioning this for any other reason, but it's kind of bang on our financial projections. We sort of projected it would be worth around 2.7 by 2024. Now, that's partly, because you've got to make straight line assumptions. That's just as much luck as it is science behind it, but it's pleasing when, a strategy sort of goes to plan. And so whilst that ownership period's only 6.5 years, really you've got to hold a property net of, selling costs and all those sorts of things. You've got to hold a property for more than 10 years to really enjoy some decent returns. But they've enjoyed nearly 7.5%, 7.4% compounding over the last 6.5 years to generate that. And if they hadn't have upgraded and purchased that home at that point in time, they certainly wouldn't be nearly as in strong position, and they might not be able to re-enter the market. Now they're separating, they'll be single, they'll need to re-enter the property market to buy a home. If they didn't have that equity and that backing, that would be really challenging to do. And I should say, at the time, it was really challenging borrowing capacity wise. At the time, 1.7 was really at the top end of our budget. We really pushed ourselves to do it from a borrowing capacity and a cash flow perspective. I remember Jody, the mortgage broker in the office, really had to, push hard to sort of get that loan approved at that time. Now, I'm not suggesting or mentioning that to entice people to borrow to their eyeballs and get themselves into trouble. But, sometimes I know personally and professionally, sometimes you've got to push yourself a little bit and you've got to push that sort of comfort level. And if you're investing in a really good quality asset, you're buying a good quality asset, and you don't put yourself in a situation where you absolutely have to sell it, like fire sell it, normally in the long run, it turns out pretty well. So as I said, when we first met them 9 years ago, they had an investment asset base of 1.35. That asset base is now $4.1 million. So they've got about $1.5 million in super. So that's tripled over the last 9 years. And they've got about 1.35 million in cash because they sold the family home, and the rest of the money is in equity and property. Perth is starting to move, of course. The investment property they had in Sydney has done pretty well. Unfortunately, South Yarra, the apartment that we purchased with the assistance of a buyer's agent, that whole market just hasn't done well again. I've spoken about that in this podcast previously. So what can we learn from this case study? Well, there's a couple of things. Firstly, it's always good to have or consider and ask yourself, what contribution will your existing investments assets make towards achieving your future financial goals? You need to make some sort of assumption around that. If they're good assets, well, you can assume they're going to deliver good average returns. If they're below average assets, well, then of course the returns are going to be below average. And then you need to work out, whether that's going to work out for you. But the decision of whether to keep underperforming assets or replace them, it's a really important one. Quality over quantity every day of the week. I'd much rather own one fantastic property, whether it's my home or investment, rather than 4 or 5 very average investment assets. Quality trumps quantity every day of the week. The third lesson I reckon we can take from here is pivot. If your borrowing capacity changes, situations change, then not always, but sometimes it's then worthwhile to think about, well, what change in strategy can I make? And I guess the overarching thing here is if if you can ever go higher quality, so if your income increases, you've got to ask yourself, is there a better quality investment than I can make? Do I keep pursuing the original strategy that I formulated? And lastly, investing in your home is a very powerful strategy. You need to think about debt management, debt control, all those sorts of things. But, pushing yourself to level up on quality on your family home is, incredibly valuable, and it really put these two clients now in a very good financial position. And I think finally, the super one, as I said, they had $500,000 in super 9 years ago and $1.5 million today. Big difference is one of the spouses had a pretty substantial income and was making some substantial contributions. That was one element. But then the other element too that I think is lost on a lot of people is it takes a long time to get to $500,000. But once you start accumulating a certain amount, it starts to really compound. And so you can't ignore that as part of the strategy as well. Super. Sometimes people just ignore superannuation. I think I'll need other assets. Well, you probably do, but don't ignore super. Make sure it's well invested. It's working well. You're paying low fees. If you do that, super will generate a lot of wealth over time. Okay, that's it for me for today. Until tomorrow, bye for now.